For an investor who has journeyed through the Indian stock markets over the past few years, navigating the Indian healthcare sector in 2026 can feel like walking into a labyrinth. You have watched the wealth creation journeys of consumer staples, information technology, and private sector banks. You know how structural shifts create generational compounders. Yet, when looking at healthcare, the sheer variety of business models from hospital chains and active pharmaceutical ingredients to contract research, biosimilars, and retail pharmacies present a confusing mix of regulatory anxieties, high valuations, and capital expenditure decisions. To make sense of this ecosystem, we must look at how industries evolve globally. Every major industrial revolution follows a predictable path. In the early days of global computing during the 1980s and 1990s, there were two kinds of entities. On one side were companies taking massive binary risks on new software and hardware standards. On the other side were infrastructure providers building the networks, personal computer assembly lines, and enterprise architecture. The massive rewards eventually went to the entities that provided predictable, scalable, and essential infrastructure with pricing power rather than those constantly fighting commoditization or spending every dollar of cash just to stay alive. The Indian healthcare ecosystem map shows this exact dynamic. We have mapped it across two major axes. On the vertical axis sits risk, separating high execution and regulatory dangers from lower, more predictable demand visibility. On the horizontal axis sits shareholder returns, dividing the value destroyers or cyclical laggards from the high performing wealth creators. In the image here, the Indian health ecosystem is divided into four distinct quadrants. By examining the structural realities of each, we can determine exactly where an intelligent investor should deploy her capital. Let us begin with the lower left quadrant, which contains early or volatile segments like small cap pharmaceutical formulation players and healthcare ingredient or intermediate companies. In the world of global commodities, there is an old market truth that the worst business to own is the one where you have no control over the price of your raw material and no control over the price of your final product. Specialty chemical and intermediate manufacturers in India are currently trapped in this cycle. They face intense global market volatility, massive regulatory and environmental compliance costs, and heavy working capital requirements. Investing here is akin to buying global steel or shipping stocks in the 1990s. You are not buying a compounding business, you are trading a highly volatile macro cycle. Similarly, small cap formulation companies live under the constant shadow of price controls and compliance audits, where a single adverse observation from an international regulator can wipe out half the market capitalization overnight. This quadrant represents low shareholder returns coupled with high risk, making it an avoidable minefield for long-term wealth creation. Moving to the lower right quadrant, we find stable and essential segments, specifically large cap generic pharmaceutical companies and retail pharmacy chains. This quadrant is a classic maturity trap, very similar to the global telecom sector after the initial mobile boom of the early 2000s. In those years, while mobile phones became essential to daily life, the companies providing the service saw their margins collapse due to intense price wars and massive capex requirements just to upgrade infrastructure. Today, large cap Indian generic companies like Sun Pharma or Cipla run mature businesses with strong balance sheets and steady dividends, but they operate in highly competitive global markets where pricing pressure is unstoppable gravity. Retail and chain pharmacies face a similar dilemma. While they represent an essential healthcare access point with recurring footfalls, they are caught in a brutal war of attrition against digital health platforms, resulting in thin margins and low returns on capital. They offer stability but not the dynamic compounding that grows wealth. Now let us look at the upper left quadrant, which contains innovators, high growth bets, biopharma companies, and contract development and manufacturing organizations or CDMOs. This is a high risk, high shareholder return space. To understand this quadrant, we must look at the global semiconductor industry. In the technology world, design firms spend billions of dollars trying to create the next breakthrough microchip. If they succeed, the returns are astronomical. But if a rival beats them to it, the capital spent is completely lost. This is the exact risk profile of biopharma companies working on novel biologics, gene therapies, and biosimilars. The growth potential is massive, but it comes with binary research and development risks and extreme capital intensity. The CDMO segment within this quadrant operates like the high-tech silicon foundries. Companies like Divi's or Syngene do not take the failure risk of the molecule itself. Instead, they provide the complex manufacturing and development capabilities for global innovators. CDMO is a highly lucrative space backed by global outsourcing tailwinds, but it's not for the faint of heart. It requires flawless execution, constant capital expenditure to build specialized capabilities, and an ability to navigate stringent regulatory standards. For an investor, this quadrant represents the venture capital pocket of public utilities. It can deliver spectacular returns, but the ride is volatile and requires deep technical monitoring. This brings us to the upper right quadrant, which holds durable growth and compounders. This quadrant houses multi-specialty hospitals, diagnostic companies, wellness platforms, and hospital management services. This is the sweet spot where low execution risk meets high shareholder returns. To understand why this quadrant is the ultimate destination for compounding capital, we can look at the evolution of the Western railroad and physical infrastructure networks in the 19th century. During the American railroad boom, investors lost fortunes backing the competitive rail lines that engaged in price wars. However, the investors who bought the land, the central terminals, and the essential urban hubs where all the traffic had to pass became incredibly wealthy. Multi-specialty hospital chains like Apollo, Fortis, Narayana Hrudayalaya, and Max Healthcare are the modern equivalent of those central urban hubs. India has a structural shortage of healthcare infrastructure, providing only 1.3 hospital beds per 1,000 people, which sits well rows below the global median of 2.9 beds. At the same time, the country is undergoing a massive demographic shift, with the senior citizen population expected to reach 15% of total population by 2036. The rising demand in healthcare is met by an explosion in private health insurance penetration, which now contributes nearly 43% of revenue for major hospital chains. This structural shift moves the industry away from out-of-pocket distress spending towards institutionalized, predictable healthcare consumption. Hospitals in this quadrant possess immense pricing power and strong asset efficiency. Once the hospital hub achieves mature occupancy levels, typically above 60%, the operational leverage kicks in. Every additional patient directly expands the operating profit margin because the fixed costs of the building and the equipment are already covered. Furthermore, these players are adopting asset-light expansion models, leasing spaces or expanding via management services in Tier 2 and Tier 3 cities rather than spending heavily on buying land. Sitting right aside hospitals are the organized diagnostic companies like Dr. Lal Path Labs or Metropolis. They operate on a hub-and-spoke model that requires very little capital expenditure to scale. The demand for preventive health and chronic disease management acts as a recurring annuity. As consumer awareness grows, business shifts away from the unorganized labs towards trusted corporate brands that offer speed, digital integration, and accuracy. This quadrant avoids product obsolescence risks, global export pricing volatility, and binary scientific failures. It relies entirely on local, structural, and non-cyclical domestic demand. When we weigh the evidence across history, industry structures, and capital efficiencies, the conclusion becomes clear. While the upper left quadrant offers exciting high growth opportunities for those who can tolerate volatility and binary risks, it is the upper right quadrant of the durable growth and compounders that deserves the central focus of a compounding investor. The combination of multi-specialty hospitals and organized diagnostics represents the highest quality of infrastructure play on India's structural economic growth. These businesses possess sticky consumer relationships, structural demand insensitivity to economic recessions, and excellent cash generation profiles. By anchoring your portfolio in this durable growth quadrant, you align your capital with businesses that gain pricing power and operational scale every single year. Exposure to such stocks could transform the complex healthcare ecosystem into a predictable engine of long term wealth creation for your portfolio. Hope you like this video. Thanks for watching.